going to go through the sell rules for how I sell a position trade and how I sell a swing trade. And just to recap, a position trade is a trade that I want to hold for weeks and preferably months. And a swing trade is something I want to hold for a few days, usually 3 to 5 days. So far, we've already seen that right at the entry, as you're taking a new trade, you want to think about how you're going to sell it. Are you going to position trade it or are you going to swing trade it? These were the criteria for the stocks that you should position trade, and these are the criteria for stocks that you should swing trade. And we also went through when you should move the stop loss to break even for a position trade and when you should move it to break even for a swing trade. So now let's go to the main sell rules that I use for my trades. If I'm in a position trade, then I sell half the stock when it makes the third leg up. I'm going to show you examples of exactly what I mean by that and what the logic behind it is. And I sell the other half either when the stock goes parabolic or when it breaks a trend line. For a swing trade, the rules are super simple. I'm just going to sell half the stock at 2R, which is twice the risk multiple. I already discussed what a risk multiple is when I was talking about the stop loss. So I hope you guys remember that. And I'm going to sell the other half in 3 to 5 days. Let me show you examples of what each of these criteria look like, so you have a good sense of them and also the logic behind them. Now, what do I mean by third leg up? So say this is a stock that is a new EP and it starts its move here. This is where I enter. It goes up for a few days, makes a leg up, pulls back, probably tests the 10 or the 20 MA, makes another leg up, goes up for a few days, pulls back, tests the 10 or 20 MA, and then it makes a third leg up. Now, after 3 legs up, the probability of a fourth leg or a fifth leg greatly decreases. So what I do is just sell half of it on the third leg up. Let me show you an example of this. So this is Miniso, and Miniso was the last position trade that I took. I took this in November when it made a new EP and broke out of an IPO base. And I recently sold it a few weeks ago. And you can check my tweets if you want to know the details of exactly when I entered and why I entered and when I sold it and why I sold it. So Miniso makes a first leg up here. This is super strong. And even though it doesn't look like much, the stock has actually gone from around $8 to about $12, which is a 50% move. It then pulls back, finds support on the 10 MA, keeps going up, makes a second leg up. Then it bases here for a few weeks, just goes sideways along the 10 and the 20. And then it breaks out and makes a huge third leg up. Now, this is when I would start thinking about selling. Since this is a third leg up, for it to make a fourth leg or a fifth leg, it's definitely possible. And currently the stock also looks like it might want to keep going up, but the probability of that is really, really low. And what I typically do is I would sell half of it here when the third leg is looking quite extended to me. And then if it breaks out again and tries to make a fourth leg, I'm happy to take it, but I take it as a swing trade because it's already a very old trend. So that would be the first case where I sell. So that would be where I sell half of the position trade. Now the other half, I'm either selling when the stock goes parabolic or when it breaks the trend line. So let me show you what a parabolic move looks like. The definition of a parabolic move is super simple. All it means that the angle of the trade has changed, the angle of the stock. So if you look at this, SPCE, this is the angle at which it's been going steadily. The same angle was maintained here. All of a sudden, in these 4 days, the angle changes. It becomes a lot steeper. So when I see that angle changing and a stock just going wild and parabolic, like here SPCE went from around $25 to $40 in like 3 days, or rather even 2 days, that's not normal. And that's when I would sell the rest of the half the position. So I would get out completely from the stock. And when a stock goes parabolic, that's usually a very good sign of it topping. Now, this can also be seen in the indices sometimes. So this is an example of the NASDAQ, the QQQ. And sometime in 2020, I remember it suddenly started to accelerate, and you can see the rate of change increased. It started to go a bit parabolic. And this is when I started to take off a lot of exposure around these days and put on less and less exposure, because this kind of move is not sustainable. And a stock is usually going to break and come down, take a few days of a breather or a pullback after it starts to go parabolic. So if either of these two scenarios occur, that is either the stock is going parabolic or the indices start to go parabolic, you can start to remove some of your exposure or even sell out completely and just book profits, which is what I like to do. Because once it's gone up parabolically, it usually falls super fast and you may not even get a chance to get out at the price where you initially were. So even in this case, you can see it just starts to get wild and then just gaps down one day. So if you don't want to be in for these kinds of surprises, then you better sell into the strength and just get out while it's going parabolic. Same thing here. The next morning, it just opens and just starts selling off. So you either sell into strength or be really quick and take a chance. I prefer the former. Okay, the last reason that makes me get out of a trade completely is if a stock breaks a trend line. Now, this is the same Miniso trade that I was. The other reason why I might get out of a position trade completely is if it breaks a trend line. So a lot of people might have heard of the rule that if it closes below a moving average, you want to sell the stock. And that's what I used to do previously too. But I found that it used to shake me out a lot of times. And a better, more logical way that I have found to do it is to draw a trend line instead. And once it breaks the trend line, to sell it at that point. So this is the same Miniso trade that we were discussing. And the second the last part of my position, I actually sold on this day and tweeted about it as well. And the reason was because it had been going up at this angle, and you can draw a trend line when it touches 3 price points at a minimum. That's when it becomes valid. Because otherwise, if your criteria is only 2 points, you can connect any 2 points and draw a trend line here or here or here, and it's not very meaningful. But once it's connecting 3 lows, that's a very meaningful trend line. And so on this day, when it broke that trend line and closed below it, that's when I actually got out of my entire position in Miniso. Oh yeah, and I have the a screenshot of the tweet here to show you that this is exactly the kind of simple logic that I use when I'm actually executing my trades. So the day before, I had tweeted, so on March 20th, on this day, I had tweeted, we now have a clear trend line that the stock is respecting, still riding my position from November, moving stop up to yesterday's low, that is here, as break of the trend line could lead to a fast move to the downside. And then on March 21st, all out on break of this channel. And in total, from my entry on this day, the stock had moved up 80%. So I hope the logic is clear behind this and this makes sense. Okay, now for a swing trade. For a swing trade, the sell rules are super simple. I just sell half at 2R and then half in 3 to 5 days. So this was the most recent trade that I closed. This was 2 days ago. I had entered Mara on this day when it broke this trend line. Next day, it had gone up 2R. That's when I booked half. And then on the 5th day, I sold the remaining position. In total, it went up 40% from my entry point, and I closed the trade in 5 days. This is a classic example of a swing trade that I would take, and the super simple sell rules that I use for all of them. The logic behind taking the partial off at 2R is that it finances my risk. So since I would have risked, say I would have risked $100 on the trade. If the stock has gone up 2R, that means I'm sitting on an open profit of $200. If I'm selling half of the position there, that means I'm booking a profit of $100. So I had risked $100 and now I've made $100 in my account. I can now use that $100 profit that I made in my account to finance a new trade. That is the logic behind selling a partial at 2R, putting some money into your account, recycling it, putting it into a new trade, and giving yourself a chance to make even more money. And the reason I sell the other half at 3 to 5 days up is because most swings, most stocks just go up in short swings of 3 to 5 days. So even take a look at Mara here. This little swing was 4 days. This little swing was around 5 or 6 days. This little swing was 3 days. This little swing was 4 days. That is just the nature of stocks. And credit to Pradeep Bonde because this is something I learned from him and then confirmed with my own study. All I'm doing is taking a structural tendency of stocks, which is to go up for 3 to 5 days, and making my sell rules around it. That is the simple logic behind this rule. Okay. This is another example of a trade that I just took and I just tweeted about today, just to give you another idea. Yesterday, I went long IoT, and as soon as it moved, since it was a swing trade, and I noted that here, as soon as it went up 1 hour, I moved it to break even. It had gone up 1 hour the same day itself. And then today, when it went up 2 hour, I just booked profits in half. And now I still have the other half open. And since it's already gone up 3 days, I'll likely sell it tomorrow or the day after.